Welcome everyone to our session on risk and return. Today we're going to dive into one of the most foundational concepts in finance, how risk and return are related and why they matter to investors and managers alike. So for instance, think about investing in Amazon versus Coca-Cola. Amazon's growth is remarkable, but its stock price is more volatile, reflecting higher risk. Coca-Cola, on the other hand, is a stable company with consistent returns, but its growth potential is limited. How do you choose between the two? That's where the understanding of risk and return becomes crucial. How do you decide which is better for your goals? So throughout these videos, we're going to explore how to measure returns, the role of diversification, a key concept called capital asset pricing model and beta. And we're going to talk about how these ideas shape market behavior and investment strategies. Of course, we're going to start with our big picture. In this case, we're looking at the cost of equity. How does the risk of a company impact the costs of financing its operations? How does the decisions of the company impact the processes of evaluation and analysis of the firm? And as this formula shows, as risk increases, the denominator increases and the value of the firm declines. So as managers, we want to find ways to minimize the costs of financing, which implies minimizing the risk of operations. So let's begin by defining investment returns. Investment returns measure the financial results of an investment and can be expressed in two main ways: dollar terms and percentage terms. For example, suppose you buy a share of Apple for $100 and a year later the price has risen to $120. Your return is $20 in dollar terms, and in percentage terms it's 20%, because you earned $20 on a $100 investment. So returns can be categorized as either being historical or prospective. Historical returns show what the investment has earned. Potential or prospective returns talk about how we anticipate future returns. So let's connect this to the real world. Procter & Gamble, a blue chip stock that provides steady dividends. If you hold its stock, your return includes both capital appreciation and dividends, making it a stable investment choice. Whether historical or prospective, understanding returns helps us decide between investments like high growth startups or steady income bonds. Analysts often estimate prospective returns by looking at factors like projected earnings growth, market conditions, and industry trends. So that's the return side. Now we want to flip to the risk part of our discussion. So risk is the possibility that the actual return on investment will differ from your expected return. In finance, we say risk is higher when there's a greater chance of earning far less or far more than expected. For example, consider Tesla. Its stock price is highly volatile, meaning it often experiences large swings in price. If you buy Tesla stock, you might see a big return if the company delivers strong sales or new innovations. But if the market reacts negatively to its earnings report, your investment could lose value just as quickly. So one way we measure risk is through standard deviation, which captures how much returns fluctuate around their average. A higher standard deviation indicates more risk. As we go deeper in this topic, we'll explore how investors manage risk, including diversification and understanding the trade-offs between risk and return. This is an example of a prediction of the returns on treasury bonds. The probabilities reflect a forecast of the chances that these economic conditions occur. The returns are the forecasts of the returns should that economic condition actually come to fruition. So if we have the most likely or an average kind of an economy, we're saying there's a 40% chance that I will receive a 6% return on my investment. In the very best case, there's a 10% chance that I actually would receive a 26% return on my investment. We base our analysis on the assumption of a normal distribution of returns. This then permits the use of average or the mean and the standard deviation as our metrics of risk and return. Now, what I will say is that individual stocks typically do not exhibit normal distributions of their returns. However, portfolios, and especially larger portfolios, do identify quickly and very often as normally distributed returns. So how can we calculate the prospective return that we expect on a stock? We need, or an investment. We need the data. We just provided the table. You notice here, here's the 10% chance that we'd have a very bad economy and we would lose negative 14% on that investment. So the return on an investment is a sum, sigma here representing sum, of the product of the probabilities and the returns. If you're using an Excel spreadsheet, if you had a column of probabilities, a column of returns, the formula is the sum product of those two data arrays. So again, expected return is the sum product of the products of probabilities and the returns. Now let's discuss standalone risk, which is the risk of holding a single asset in isolation. The key metric for this is standard deviation. It measures the dispersion of outcomes, or how much of an asset's returns can vary from its average return. Let's think about Netflix as an example. Its returns have been exceptional during periods of strong subscriber growth, but its stock price has also plummeted when subscriber numbers fell short of expectations. Standard deviation measures this variability. A high standard deviation for Netflix reflects its higher standalone risk. In contrast, a company like Johnson & Johnson, with very steady sales in the healthcare products, has a lower standard deviation, making it less risky as a single investment. To summarize, while standard deviation helps us quantify standalone risk, it also highlights the importance of understanding your risk tolerance and the need to manage that risk. Here we see the formula for standard deviation, and note that the formula is the chance, probability, that there's a difference between what you expect to happen and what happens. What you expect to happen and what the average of your expectations and what actually happens in those economic events. So the formula is the sum product of the probabilities, then you need a column of returns minus the return, or minus the average, and then that same column again, because it's going to be squared. That will give us the variance, and standard deviation is the square root of variance. So note that the formula, that's the chance of the event multiplied by the difference between the expected return and the predicted return. Again, this was our definition earlier. So in our example, again, we have noted this comes from our standalone risk worksheet. We can identify probabilities. We input those. You input the assets. These are assets for our T-bond. I've also included some returns for another asset. And now we can look at the statistics. So for asset A, we have a 6% rate of return. So what this says is if you buy asset A, you would expect to earn 6% over the next year. Asset B, 1%, obviously a much lower rate of return. Standard deviation is the measure of risk. In this case, you notice that asset A is 10.95, asset B is 7.06. So we would say that in this case, it appears that asset A has a higher risk level than asset B. Now we also have another statistic called the coefficient of variation that's very important when we want to compare assets with markedly differing magnitudes. In this case, you actually notice it kind of flip-flops on us, that because of the very low return of expected return here for B, it really tells us that B, relatively speaking, is actually much riskier than asset A. Asset A's coefficient of variation is 1.8 and B is 7.05. So looking at standard deviation alone as an asset all by itself, we would say it appears that A is riskier than B. However, making comparisons, we may have a differing opinion. So investments with bigger standard deviations have more risk. High risk doesn't mean you should reject the investment, but you should know the risk before investing. You should expect a higher return as compensation for bearing that risk. So that's the end of this video. I look forward to seeing you in the next one. Bye-bye.